In this video, I will cover how to determine if a stock dividend is safe and a dividend policy is sustainable. Dividend investing gained a lot of popularity recently. Many YouTubers tout dividend stocks and their steady income streams. They show you their monthly dividend income and tell you how you can do this too. But there is very little education given on dividend safety and what kind of red flags to watch out for. The research that you must do for dividend stock is very similar as for any other stock, and you must look into three pillars. Those are economic moat, finances, and valuation. And each of these items build on top of each other. Before even looking at various financial ratios, the key thing to dividend safety is economic moat. So what I mean by economic moat? Economic moat is a durable competitive advantage that allows a company to earn excess profits for a long term. I made a separate video on economic moat where I give plenty of examples with explanations of how to determine economic moat. I link this video above and in the description. But in essence, you want a company that does certain things better than its competitors. Moreover, these better business practices must be hard for competitors to replicate. This unique combination of factors allows a company to earn excess returns, which are just return above its cost of capital.
For instance, it could be GPU technology that enabled Nvidia's meteoric rise to stardom, or it could be a brand that Nike built around its sneakers, or cost efficiencies that your local utility firm developed. Either way, economic moat should be a priority to know for a dividend stock.
Assessment of a company's economic moat is a qualitative study for the most part, but there's one metric that you can use to assess economic moat, and that is the return on invested capital. Return on investment capital is defined as a net operating profits and losses after taxes divided by invested capital. I will have a separate video on return on investment capital soon, so stay tuned for that and subscribe to my channel.
For instance, take Intel. Intel has enjoyed an outstanding return on invested capital up until 2019. But many factors eroded its economic moat, and Intel lost its competitive edge. Many of its competitors, such as TSMC, zipped past its chip technology. Recently, AMD started taking Intel's market share in the cloud service market. Consequently, Intel's return on invested capital declined due to falling profitability and low growth rates. Eventually, Intel had to cut its dividend from $1.46 to 50 cents per share in 2022.
Strong economic moat can minimize the risk of capital depreciation for a stock. In the end, it doesn't matter what the dividend yield is. If a stock price declines by, let's say, 20%, who cares about a 3% yield? There are many companies that lure investors with a high yield only to experience financial problems, dividend cuts, and stock price declines. So investors, be aware. The next task is to look closely at a company's finances. Here you want to study the following metrics: the quality of revenue and earnings growth, debt ratios, free cash flow metrics, dividend growth and history, and payout ratios.
Let's look at a specific company to illustrate the point with the benefit of a hindsight. Take VF Corporation, VFC, which announced a 41% dividend cut in 2023. Currently, its forward dividend yield stands at about 6.4%. VFC is in the apparel business. Its brands collection include Vans, The North Face, and Timberland. Looking at VFC's income statement, we see that the top-line growth was non-existent in the past 10 years. There is notable exception in 2021, with a 28% jump in revenue growth. The operating earnings growth had a similar or even worse picture.
Overall, it's important to look at the quality of the revenue and earnings growth for a company. If a growth comes mainly from expensive acquisitions or one-time events, it's no good.
Looking at VFC's 10K, we learned that about 6% of the 28% growth came from acquisition and favorable forex fluctuation. Thus, this leaves us with 22%. On the surface, this looks impressive, but that number is mostly based on consumers' shopping spree after COVID-19. It's very unlikely that this double-digit growth rate is sustainable. As for return on invested capital, VFC showed more or less consistent results, but there was a declining trend after 2019. Similarly, operating margins started declining after 2019. Even post-pandemic bump didn't help the company. Thus, it looks like 2022 was just a temporary reprieve.
Based on my research, there are several factors behind this, but the main one is this, and it's the changing retail landscape in the US. There are many clothing stores that are closing or going bankrupt, and this puts VFC's distribution channel in total disarray with its unpredictable ordering, pricing, and distribution channels. As you see here, it's important to dig deeper and understand how long these negative trends will last into the future.
Next is the leverage. Back in 2018, VFC had about 2.8 billion in debt. Fast forward today and we have 8.2 billion on the books. Increasing debt doubled VFC's financial leverage. At the same time, its debt-to-equity ratio increased almost fivefold. VFCs took on more debt to cover acquisition, declining operating cash flows, and dividend payments. Further, operating cash flows showed a clear downward trend, and despite this, VFC still maintained and even increased its dividend over the past 10 years. As for VFC's payout ratio, it's very volatile. The payout ratio is the dividend divided by the net income.
In my experience, the traditional payout ratio is a somewhat flawed metric. This is so because net income includes a lot of noise in it, such as non-operating and non-cash profits and losses. A better metric would be a dividend divided by the free cash flows. A free cash flow is the operating cash flows net of capital expenditures.
From this diagram, we see that the dividend to free cash flow ratio was becoming less and less sustainable. For an astute investor, this dividend cut was a matter of time. VFC had to take this measure to preserve cash for debt prepayments and other operating needs.
Another aspect of dividend analysis is to look at a company's valuation. Unfortunately, countless books were written on this topic, and I can create hours and hours of video tutorials on investment valuation. Unfortunately, for this reason, the full-scale valuation analysis is just beyond the scope of this video. Think of looking into a company's valuation as a hedge against price declines in the future. If you buy a company's stock at a price that is below its intrinsic value, you get certain margin of safety. This margin of safety will safeguard you against price declines in case you turn out wrong. If you want to learn more about investment valuation, subscribe to my channel. Also, you can educate yourself by reading various books on valuation. One authoritative book that stands tall above anything that I have seen is Valuation by McKinsey Co. Whenever I have questions, typically this book has comprehensive answers.
Let's take a look at VFC relative valuation and try to tease out if the dividend was safe before it was cut in 2023. So let's take a look at price to sales, price to book, and enterprise value to EBIT. We see that all three ratios were somewhat elevated around 2020 and 2021 on a historic basis. So that is one way to look at it.
But looking at a relative valuation on historic basis only misses on many important aspects. These aspects include risk, future expectations of growth, reinvestment needs, and returns. So, for example, consider two identical companies, Company A and B. They are identical in all respects except that Company B is expected to show higher future growth. In this case, Company B should have a higher relative valuation. So, if you're not controlling for these metrics in your valuation, it's a pointless exercise. Also, it's important to compare a company's relative valuation to its peers. In short, there's a lot of digging to do here before we can conclude if a dividend stock is worth investing.
In the meantime, let's add VFC margins, returns, leverage, and valuation metrics together. From this table, we can see that the relative valuation metrics are at all-time low, but so are returns and margins. On top of that, VFC became much more levered. Depending on what the future holds for VFC, it could be a fantastic value play with a great dividend yield. Conversely, it could be a terrible value trap with even more stock declines.
From here, we need to study VFC's current competitive dynamics and its industry. Only then we can compute VFC's intrinsic value and determine if it's worth investing. In my future videos, I will have more in-depth discussion of companies' relative and DCF valuations. If you have no time for this research, it's much better to invest in a dividend-focused ETF. Of course, you will not get the same yield as with VFC, but at least your fortunes will not tie to only one company. That is it for this video. I hope you learned something new today and you got something out of it. If you enjoyed it, please give it a like and subscribe to my channel for more videos in the future about investing. Thank you for watching.